One of the things that Commissioner Aguilar has talked a lot about, and he spoke about it in his opening remarks this morning, was the whole issue of elder financial abuse and sort of the results of elder financial abuse, some of the causes of it, what it looks like. And one of the things that we've talked about previously in some detail is the role of diminished capacity. At a certain point, almost everyone, I think, experiences, if you live long enough, diminishing capacity. And what we wanted to do was talk about those two things as really part of a continuum, rather than two separate things. And we really have a fantastic panel that's going to talk about it in a number of different areas, focusing on diminished capacity, how to detect it, what it means, talking about elder financial abuse, what it looks like, what can be done to combat it, talk about the enforcement side. This panel will be moderated by SMEETA RAMARATHNAM, who is the Chief of Staff to Commissioner Aguilar. SMEETA specializes in a wide portfolio of financial reform and securities law issues. She and I have worked together over the past couple years, and it's been an absolute pleasure. Again, her job responsibilities include, among many other things, negotiating on policy matters, participating in meetings on a wide-ranging number of securities policy issues, and managing the Office of Commissioner Aguilar. And prior to her appointment in this current role on Commissioner Aguilar's staff, SMEETA served in a number of capacities here at the Commission, including as counsel to former Commissioner Roel Campos, and as an attorney in the legal policy group of the Office of the General Counsel. SMEETA has her JD and undergrad from Stanford University. You just got back from the Rose Bowl. I want to talk about that. And one of the really fascinating things, and to me this is always really exciting, things that you've done is created and taught a class to Stanford undergrads here in Washington on public policy making or federal policy making, which I think is really just very cool, very fun. So without any further ado, SMEETA. Thank you.
Thank you, Keith, for that very generous introduction. Good morning. How are you all this morning? Thank you so much for being here. Commissioner Aguilar and I are just so pleased. This is a topic that we know that many of you and many of the folks I share the dais with this morning care a lot about, and are thrilled that the Commission is taking a day to really focus on the topic of seniors, their vulnerability, and how they're being exploited, and what can we do about it. So today's panel is really focusing on the issues surrounding elder financial abuse and the strong link with diminished capacity. We're going to get into the issues where the panel will be completely interactive, so we won't have prepared presentations as such, but we're going to have it be an organic discussion, and all my panelists are going to jump in. And then we are also going to save time at the end for questions from you all. So please be thinking as our discussion ranges what you may want to ask and what you may be thinking about already. The way we've structured the panel is we're going to start off by talking about the magnitude of the problem. You know, as we know only too well here at the SEC, folks are literally defrauded every day, right? Whether they're young, they're old, whatever their shape, their size, their color. But why is this elder abuse problem magnifying? You know, why is it exponentially growing? We want to get into the magnitude of the problem. What's fueling that problem? What are some of the barriers to progress? Will be the second section that we cover. And then we'll talk about possible solutions. We don't want to leave this discussion without really thinking about how do we move forward, how do we make progress. So now it is truly my privilege to introduce my distinguished panelist up here with me. And it's this particular treat for me to be able to introduce my SEC colleagues. Often I feel like I get to speak, but I'm the only one. As we all know, we'll have the one government person and then the other folks on the panel. And so today that is not the case. I get to introduce two of my SEC colleagues, and I'll start with Rebecca, who's the furthest away from me. Rebecca FRANCISCUS is joining us from the Denver Regional Office. She's an attorney advisor in our enforcement division. She provides analysis and strategy for new enforcement matters investigated by that office, and she coordinates relationships between the SEC, other law enforcement partners, and community partners throughout the Rocky Mountain region. Rebecca is also responsible for investor outreach and education throughout that region, and she has presented fraud-fighting information to over 13,000 investors since 2007. And just next to Rebecca is Lourdes Gonzalez, who Lourdes is a true hero for many reasons, including she stepped in at the very last minute for another one of our panelists who came down with pneumonia yesterday. So thank you to Lourdes for that right off the bat. But Lourdes is another one of our folks who is just highly, highly experienced, and we're lucky to have her. She's an assistant chief counsel for sales practices in the Division of Trading and Markets here at the SEC. That office has program responsibility for a broad range of broker-dealer sales practice issues, as well as broker-dealer supervision, anti-money laundering, compliance, and securities arbitration. In her prior life, prior to joining the chief counsel's office in TM, she was a counsel for Commissioner Laura Unger here at the SEC, and then prior to being at the SEC, she was at the Department of Treasury. Next to Lourdes, we have Doug Kelly, who has very graciously agreed to join us. He is an assistant general counsel at Wells Fargo, supporting retail brokerage. He served prior to that as the general counsel of Wachovia Securities, LLC, and of Wachovia Securities Financial Network, LLC, from February 2008 through March 2009. Mr. Kelly previously was Executive Vice President, Chief Financial Officer, Treasurer, and Corporate Secretary for A.G. Edwards Incorporated, the holding company whose primary operating subsidiary was the brokerage firm A.G. Edwards & Sons, and was Director of the Administration and Director of Law and Compliance for the brokerage subsidiary. Next to Doug, we have Ryan Wilson, who may be familiar to you all. I know he's familiar to me. We've worked together for many years now. Strategic Policy Advisor at the AARP's Public Policy Institute. Ryan analyzes consumer issues related to insurance and investments. He has been with AARP since 2007. As part of his work, Mr. Wilson serves on the Consumer Advisory Committee of the Interstate Insurance Product Regulation Commission. Now, you all try to say that 2 times fast. And on the Standards Advisory Committee of the Insurance Marketplace Standards Association. Prior to joining the AARP, Mr. Wilson spent 9 years working for the Maryland General Assembly's Department of Legislative Services, where he was active in the National Conference of State Legislatures and served as the staff chair of the NCLS's Financial Services Committee. So as you can see, we have a great panel lined up for you today. And so without further ado, we want to get right into the magnitude of the problem facing American seniors. So I'm going to turn to Lourdes and Ryan. And Lourdes, if you want to start off and talk a bit about the scope of the issue, the demographic data of why we have such a large problem on our hands.
Thanks a lot, SMEETA. So right off the bat, I think we need to acknowledge that there isn't a definition of senior. I'm going to pick the age 65 because it's as good as any. Although my husband, who is not 65, has been getting solicitations from the AARP, and he has quite a beef to pick with Ryan's employer. He's not happy about that.
It's not my fault.
So just very briefly, if we say baby boomers are 65 or older, and that is people who were born between 1946 and 1964, they started turning 65 3 years ago in the year 2011. Right now, there are around 40 million people in the United States who are 65 or older, or around 13% of the population. By 2030, that number is expected to be around 20% of the population. And one notable difference between older Americans and younger ones, as you can very well imagine, is they have the most, they've made the most economic gains, the most dramatic economic gains versus other households. So that's really where the investable assets are, and that's where most IRA accounts are today.
Thanks, Lourdes. One of the other things that the aging population presents is the ability for or incidence of diminished capacity. According to the Alzheimer's Association, now there are about 5.5 million people who have some form of Alzheimer's disease. That, with the expected growth in the older population, as Lourdes mentioned, is expected to grow exponentially over the next several years. As well, also, as we expect to see a growth in the number of older people as life expectancy increases. Currently, 1 in 8 people age 65 and older has Alzheimer's disease, and over half the people over 85 have some form of Alzheimer's disease or other dementia. So these people are at risk. When we were talking about the idea of financial fraud and elder financial abuse, these people are the at-risk population, or the beginning of the large meat of the at-risk population.
Great, thank you, Brian. And Rebecca, can you talk to us about why are seniors particularly vulnerable?
Well, absolutely. I think it's a two-part answer. While there's a host of factors, I think the first is that fraudsters go where the money is. And as Lourdes just said, this significant senior population holds a significant number of our investable assets. And fraudsters definitely target those they think they can get the money from. It's that simple. September 2013 FINRA Foundation study determined that those 65 and older are 93% more likely to be solicited, and then 49% more likely to actually engage in an investment. Moreover, compared to those in their 40s, those 65 and older are 34% more likely to lose money once they've invested. So they are being hit with a barrage of tactics and solicitations as they are at a crossroads reaching into their retirement years. I also think that the second factor really is sometimes seniors just don't see it coming. They don't recognize that they themselves could be victims. And as the title of our panel says, that it's granny, it's also grandpa. In fact, research shows that 2/3 of investment fraud victims are between 55, 65 years old and older. They're men, college educated, financially literate, typically married. So it really debunks the myth of who is the victim and who are we trying to target with our efforts. And so if we look at the broader senior population, not just granny, I think that's why they're targeted.
Great, thank you. Doug, can you jump in here and give us your perspective, the industry perspective in terms of the assets? Like what kind of assets are we seeing in this demographic?
Well, contrary to a lot of our ads that show the young couple and the toddler running down the sidewalk, and that's important, as the prior panel said, to get people to invest. The assets are held by those over 50. Depending on what statistic you look at, 70-78% of the assets are held by those over 50. By our own indication, in other research, probably half of that, whatever that percentage is, are held by those over 70. So what we're really talking is what our chief compliance officer calls our clients on CPR. That is clients past recovery. If these people lose what they have saved, they're not going to get it back. It's that simple, and that's what we're dealing with. And it's not just the size of the population and the amount of the assets, but it's what our bond traders would call duration risk. Good for the population, people don't die as soon. But for the issues we're dealing with, that stretches out. You have to make those assets last longer, and you have to make them last in as people decline. There is a different side to that duration risk, which is that sometimes family members look at that as a delay in their inheritance, and they decide to speed that process. And as we get into abuses, you're going to find out the number one issue is going to be family members. And obviously that is a very difficult issue because you're not only dealing with diminished capacity, you're dealing with love or perceptions of love, and you're dealing with loneliness, and you're dealing with everything we bring to our family. How do we respond to this? It's a huge issue. It's one, frankly, where the industry and our regulators and our the others involved in serving this are jointly aligned that it is a problem that none of us have the answer to. I don't think any of us believe that we have the solution. I think we're beginning to take the steps to try to work together to make it, but it is a huge problem.
Absolutely. Let's explore, what does diminished capacity mean? Ryan, if you could weigh in on that. I know for a lot of folks, people say, well, you know, my father or my grandfather has not been diagnosed with dementia, you know, doesn't have an official diagnosis. Let's talk a little bit about what is diminished capacity. What are some examples? You know, what does that look like?
Well, first off, let's talk about what financial capacity is to begin with, and then we'll kind of back it out to figure out what diminished capacity is from that. Financial capacity, and there are several definitions, but I think a good working one is the ability to be able to manage your finances consistently with your own self-interest and your own values, including risk tolerances and other factors. So if you back out from that, what diminished capacity is, it's the lack of ability to do that for some reason or another. There's some research that shows that being distracted, whether it's because you had a bad day or you've experienced a loss in your life or something like that, can diminish that capacity and that capability. But for many others, those who are in Alzheimer's, those who are before Alzheimer's, those even with what's known as mild cognitive impairment, lack that ability. And one of the problems is that the math skills, the ability to do general math, which is something that's needed for financial decision making, is one of those skills, and financial capability generally is one of those skills that is earliest to go when we're seeing people slide into a form of dementia. So that's why financial professionals, I think many times, are the vanguard at seeing that. There are other things that mom, dad, grandma may do that the family's not going to notice, or the family may notice, but the financial professional, the person, especially an advisor or something like that, who's dealing with somebody on a regular basis, may start to notice things that are different about their client, Mr. or Mrs. Jones, and see, she used to, or he used to, understand exactly what I was talking about. Now I have to take 4 or 5 times to explain the same investment option to them. Those are the kinds of things that start being early signs. They're not, it's not just because you have that, doesn't mean you're entering dementia, but those are the kinds of warning signs that we think of.
Absolutely. Lourdes, if you and Rebecca could jump in here with, from the regulator perspective, from the SEC's perspective, what do you see in terms of diminished capacity, and what are some examples of how folks are being abused?
Well, right now, OC and FIN are conducting an exam. They have an exam initiative looking at senior issues, and they're looking at a number of issues dealing with seniors. It runs the gamut of all the sales practice issues one can think of for broker-dealers: disclosure, advertising, marketing, senior designations, registered rep training, especially the training as it relates to diminished capacity, elder and financial abuse, and supervision and suitability, which are very important issues as well. What the examiners are seeing is actually they're looking more broadly than just diminished capacity or elder financial abuse, as I just mentioned. And the sorts of issues that they're seeing are things that you can envision in a low interest rate environment that we're in right now. So they're seeing unsuitable sales, unsuitable recommendations of what we call basically complex illiquid securities, hard to get out of. The usual suspects: business development companies, non-traded REITs, Reg D offerings, oil and gas ventures, They also had enforcement had a case recently involving a Ponzi scheme targeting elderly investors. It's called Emmanuel Saras Sr. and Saras Financial Group, which in this case, these elderly investors were being lured through free lunch or dinner seminars. And we dealt with these issues of free lunch, free dinner seminars years ago, and frankly, I thought it was over. I thought that there wasn't really much going on anymore, given the extreme focus that regulators had had. But they do continue, and sometimes they're good, and sometimes they're vehicles for doing bad things involving seniors in this case. So that's an example. We also receive suspicious activity reports that are filed with this agency by banks, in our case by broker-dealers, that indicate elder financial abuse. And suspicious activity reports are something that broker-dealers must file as part of their anti-money laundering obligations. And there are a lot of rules around what a broker-dealer must do for to prevent money laundering occurring through the broker-dealer. But all these rules are really driving towards the filing of these suspicious activity reports. The agency in charge of all these rules, the name is Financial Crimes Enforcement Network, or FinCEN, it's a Treasury Bureau, has been focusing, among other things, on elder financial abuse. They recently revised the form that broker-dealers must use to file these suspicious activity reports. And what we've seen in the last 2 or 3 years has been an increase in filings. And now there's a box actually says, I believe it says elder financial exploitation or elder financial abuse, that brokers and banks and others can check to indicate that this is the type of suspicious activity that they believe is going on at the broker-dealer. But the main point is they have been increasing their filings indicating elder financial abuse. And I think they've been increasing it because FinCEN has shown a spotlight on this issue, to their credit.
Well, and I agree, Lourdes. I think that research has shown that about 8 in 10 investors are solicited to engage in a potentially fraudulent scam. And with that, you have to consider that from an enforcement perspective, I have a very, very busy day job. And I think most everyone in enforcement has a very busy day job. And I would love at the end of my career to say, you don't need us anymore. But fraud is commonplace, and I don't think that it's going to stop. Con artists do it because they're good at it, and it's lucrative for them. So as from an enforcement perspective, I think we're seeing, again, along the lines of what the exam staff is seeing. It's off-market frauds. It's oil and gas scams. It's those illiquid, difficult investments. And I think as our baby boomers are approaching that retirement age, and they are having that decrease in their cognitive abilities around financial decisions, we're having a increase where through things like self-directed IRAs, we are more likely to be susceptible to fraud. In most of the enforcement cases I have brought over the last 10 years, those involving seniors, I have seen self-directed IRAs in every single one of them. And most of the frauds are off-market scams. They are those who have liquidated their annuities, those who have liquidated their retirement plan accounts to put it into something else. And I think what's the best part of that is there's a point. There's that point where you need to file that SAR if you're a broker-dealer. You need to be proactive if you're in the industry, because that is the point where we can actually step in and make a difference from an enforcement perspective. Typically, we're too late to the party. The money is gone. And in only one case in my entire career have I ever been able to return 100% of the funds taken. One. And so I think we want to be a little bit more proactive, and I think that's what this panel is about, is identifying these commonplace frauds earlier and often.
Great.
I'd just like Lourdes to know that I've already started getting solicitations to free meals. Should I take them up on those?
Well, and
How hungry
I
are you?
agree, Ryan. Actually, I just, as a benchmark, how many in here have gotten a solicitation to come on down for a free lunch seminar? Exactly. I think we are seeing a significant resurgence in the free lunch seminar. I get them. And that's something I think we as regulators and in our public-private partnership can work together on.
Plus, I think we have to think about there's so many more distribution channels for media, right? Facebook. I mean, and so I think folks are also just not as savvy. So you can get bombarded. It's so much easier to distribute your invitation, right, for free lunch or et cetera. So on that vein, Doug, can you weigh in with the industry's perspective of sort of the range of abuses that you see and give us some examples?
Yes. So, I'll start with the perfect storm analogy. You got to have one of those. So we have as I said in the earlier panel, we have the search for yield. Who can live on a 10-year bond at this point? You have people poorly prepared for retirement. You got to shift away from employer pension plans, otherwise meant you have to control it yourself. And you have a lot of seniors that don't live close to their families or a support network. How's it manifesting itself? It really plays out messy. And that's the one thing, there are two key takeaways. One is, once it's occurred, you may have an enforcement action, but that doesn't help anybody eat. It may get somebody off the street. And the other are, these situations are not clear. We see, number one, family disputes. Two, new and expensive friends. We see POA abuses. We see third-party scams, and we see people who are confused and we're not thinking. Let me give you 4 situations. To give you an idea of the magnitude of this, we're going from 3 people dedicated exclusively to elder financial abuse to 10 this year. We had over 1,200 escalated issues that after the first responders last year. Let me give you 4 that were pulled out of 1-month report. 2 or 3 sentences on each. 1, 3 representatives from another financial firm show up at one of our offices demanding immediate transfer. The customer is there, demanding immediately transfer of the funds, describe the investment, which is an investment which we would not sell. 2, widow has taken over $100,000 from her account in the last 6 months, will not say where the funds are going, but is praying for their return. And she's depositing it in an unaffiliated bank, so we can't see where it's going, will not authorize speaking to a family member. 3, recently widowed customer is befriended by a person with a felony conviction who moves in with her, and she has paid several $100,000 to bail out the felon's son, pay off his fines, pay his unpaid child support. And 4th, client has withdrawn over $250,000 and shipped it off to foreign lotteries. 50-year-old son who has POA refuses to get involved. Client has been told it's a scam, but said no, he's been to Spain and seen the winnings. So the commonality here is those are calls from our branches. You don't have 6 months to decide. You have to say, do we allow the client to have assets? Wait a minute. We all can control our assets, right? Who can tell me what I can't do with my funds? Do you call son, daughter? Wait a minute. We've got laws against that, right? Protect my privacy. I'd be very irritated if someone called my son and daughter and started talking about my assets. Do you report it on a SAR? Which is, the answer is yes. But guess what? No one's showing up the next day. Do you report it to enforcement? How long does the average enforcement check? That's the real world. And that's what we're dealing with in terms of daily calls. And they aren't clear, because each one of us gets to control our own assets. Each one of us gets to decide whether we throw our money away or use it, right? Right until the point where we can't.
Exactly.
And that's why we're here. Another huge issue we're beginning to see, which I think ties right into the cognitive ability, unsustainable withdrawals. So we all know a scam is bad, right? We all know going to Spain to see your lottery winnings are questionable. But what do you do with the person who says, well, interest rates will go back up, market will go back up, I can take out 10% a year? Well, maybe you can't. You know, the economists would probably say if you're healthy and of an average age, 3 or 4%. What do you do if they're really making a bet and you don't believe it's irrational? And that's a major developing issue, and it goes to that ability to have a sustained and recognizable discussion.
You know, when we were doing that, we talked to one compliance officer from a large financial firm who said, you know, you pick your lawsuit.
Yeah.
In that instance, you know, do I get sued by the client for doing the right thing or the wrong thing? Or get sued by the family member?
And I think, and here we're talking about the reporting at the intermediary level, right? I mean, this is where we're talking about reporting that we know of. And at this point, you all have a very good sense of the magnitude of this problem, right? It's exponential, it's huge. It affects folks we know, folks in our families. This is a very real problem. And the demographics are such that it's almost overwhelming. But let's think a little bit about, what about the cases we don't know about? Right? What about the seniors where we'd never hear anything? And Rebecca, maybe you can weigh in a little bit here about why are we concerned about underreporting?
Absolutely. Well, in the Denver office, we've been focused in on investors to teach them to recognize, refuse, and then report the scam. It's the 3 new R's of investing, and that's what we're trying to educate them on. But what we're concerned about is that statistics show underreporting can range anywhere from 60 to 80%. So if it's so significantly underreported, we are missing the fraud. We are not acting as both public and private partnership here. And I think there's 3 major reasons that have been identified in the 2013 FINRA Foundation study for underreporting. And I like all of them because I think it does help us recognize what we can do to resolve the problem. The first reason that investors gave was 1, they don't know where to report. 2, they don't think reporting matters. And 3, they're embarrassed. So I think if we can look at those 3 factors and respond to those 3 factors, we can teach them where to report. That's the easiest. 1, making them think it matters. From an enforcement perspective, when I take an investor statement, the way I listen to them matters. The empathetic listening matters. And most of us in enforcement, we're good at getting the facts, and I just want the facts, and I want to get it in my declaration so I can move quickly. But we forget to look at the investor, that senior as a whole, and look at the impact it has on their lives. And I think that goes back to what Doug and Ryan had said, that we really need to be a little more empathetic in the way we get our story, not sympathetic. These people aren't stupid. They're smart, hardworking individuals who have been scammed, and that will help us overcome the embarrassment factor. They're afraid of that loss of their home, loss of independence. They're embarrassed that they engaged in a fraud, but sometimes they just didn't see it coming. So the way we listen can be helpful, and that's why I think it's really important to focus in on the reporting segment.
Thank you. Now we're going to shift the discussion because I think our panelists have done an excellent job of really laying out sort of the scope and the magnitude of the problem, and talk a bit about the barriers. Why is this problem growing exponentially? What are the reasons? Why aren't we seeing more progress? And Lourdes, if you could start us off with talking about how elder abuse has typically been a state, not a federal issue, and what the ramifications of that are.
Sure. So I've been to a number of conferences and roundtables with Wells Fargo, with Doug, on this issue, and I always come away frustrated, not by the discussion that's going on, but how we can possibly address this issue. And what it really comes down to is elder financial abuse is everybody's problem, therefore it's nobody's problem. And I think, Doug, you will, you've had this experience. You report to the state agency, Adult Protective Services, but Adult Protective Services is woefully understaffed, undermanned, and really can't take this on. What I've heard from some people is that Adult Protective Services in some states will not actually investigate elder financial abuse. They will investigate if there's physical abuse because they're really so stretched for resources. So I think that the biggest barrier that I see from a regulatory perspective is really resources. We have the tools to get to have people report, particularly broker-dealers, to report suspected elder financial abuse into the commission. The primary tool we have is this suspicious activity reporting requirement that broker-dealers must file if they see suspicious activity occurring by, at, or through a broker-dealer. They may also, privacy may be a concern for broker-dealers because there are privacy restrictions on contacted unaffiliated third parties if the consumer hasn't given his or her permission for that contact beforehand. But there is an exception to the privacy rule if there's suspected fraud going on. But again, they can contact us, they can file a suspicious activity report, and the question is who's picking it up on the other end and running with it, because these may be discrete cases, low dollar amount. I went to a presentation that was hosted, a roundtable hosted by Wells Fargo. I think it was over a year ago, probably 2 years ago, and I was sitting at a table that really, at the end of the presentation, it really encapsulated the problem. There was somebody, it was a local law enforcement officer who said to me, we don't want to receive these tips because we don't have the people to handle them. Our department's budget has been cut. I think that's the main problem.
I would agree. We had a conference and we had the FBI, the Secret Service. We even had the beat policemen, et cetera, and great people. You know, everybody trying to do right. Tremendously under-resourced. Some were very blunt. Unless somebody's bleeding, we're not going to get to it. These are tremendously difficult cases. I'm sure Rebecca will agree. $100,000, your witness may have declining mental capacity, may be confused, may be embarrassed. The money is gone. You're not going to get it back. How much time and effort can you spend on the street digging that up and prosecuting it? Also, the fact is that most of the adult protective societies are social worker trained. There's a whole financial issue where training is needed and resources are needed, and you need the cooperation of the witnesses, which is very difficult. Now, there are some stories, some great stories, where people have gone probably far beyond their capacity. I can think of a sheriff, who I will not even say the state, who way over his capacity went into a branch office and literally told the client, no, you're not allowed to pay that money. The money was going out on a wire transfer to a known scamster. I'm sure that sheriffs was not totally empowered to do that, but it stopped the transfer. I'm not endorsing that, but occasionally it, people acting reasonably helped.
And also, for context, think about what has happened in the last few years, right, at the state and local level in terms of financial crisis impacts, where a majority of impact was had at the local and state level government. So that they had massive, massive layoffs, cuts, and so that affects the folks that Doug's people are able to work with, right? Mm-hmm. There's a lot more limited capacity at that level. You're starting to see more movement at the federal level. Right now, there's an Elder Justice Coordinating Council that's looking at these issues. The GAO a few years ago put out a study, again, calling for more action at the federal level. But as we all know, resources are stretched at every level, and so there's no easy fix. So Ryan, if you could weigh in here and talk a bit about the research about just how older people have trouble detecting fraud.
Yes, there is some significant research on the issue of being able to detect fraud. Rebecca mentioned earlier one of the barriers to reporting was embarrassment by the older person. Many times those people are embarrassed, think that they might lose control of their finances if they do report. There's research showing that even absent some sort of diminished capacity, older people lack or start to lose certain financial capacity and financial capability. There was one study in which they asked people to perform rudimentary math problems. We're not talking about the long problems or anything like that, but rudimentary math problems. And those age 20 or so performed in the 75th percentile, where the average 80-year-old performed in the 20th percentile. That's the average person, not really smart person or really dumb person. There's also recent research within the last year or so starting to show they're looking at brain function and ability to recognize tells in lying and in fraud. And in one of those things, the study shows that as we age, the brain ages at different speeds. And one of those things that ages faster and we lose that ability is the ability to recognize facial tells. The facial tells that we all know when we think or suspect that someone's lying to us. And that may be one of the reasons that older people are particularly vulnerable to these types of scams. That they've already lost that ability, not because they have dementia, but because of their age. That part of the brain has aged out. You know, we know that younger people lack the ability to assess risk adequately. That's why teenagers do what they do. And we all are familiar with that. It doesn't. We're amazed at how much saner they become later when they hit their 20s and 30s. But now we know that there's a problem on the other end too, that we lose that ability. One of those abilities is to see lies, and that may be one of the reasons why older people are particularly vulnerable.
Thank you. And Rebecca, if you could jump in here, I know all Americans, not just older Americans, have trouble detecting sort of the red flags of fraud. So if you could talk a bit about that.
Absolutely. Research has shown when you've listened, the AARP Foundation, Doug Shadell in Washington, and the FINRA Foundation several years ago listened to 300 undercover fraud tapes from actual investment pitches. And what they determined that it doesn't help to necessarily teach people about compound interest and how your surrender period on your equity indexed annuity works. None of that works. But what works, and what seniors sometimes have, and all investors have a hard time seeing, is the tactics. And there are 5 most commonly used tactics in all frauds. And the interesting thing, and I'll go into those 5, is that in investment fraud pitches, even more than used car sales pitches, these tactics are used over and over again, and they're used to individualize the pitch. So if you want to save for your grandson's college education, they're going to tailor that pitch to you. And the way they do it are these 5 tactics. The first one is phantom riches. Those are those guaranteed returns. It's when you open up your newspaper and you see 20% of return a month, guaranteed risk-free. Phantom riches are just something you can't have. Second pitch, and that's usually the opening salvo in an investment pitch. It gets the hook. The second one is source credibility. And source credibility can be easily faked, but if you think about it, why did I put on a suit today as opposed to flip-flops or my Denver Broncos jersey, in part because I'm still sad about that. But mostly
Rightly
it's
so.
and we're a little embarrassed in Denver. But source credibility, you wear a suit, a tie. In frauds, it's easily faked. I had an investor who was picked up by a guy out on parole who had rented a Series 7 BMW, drove by a huge mansion and said, "There's my house. The gardeners, yep, they're gone," and had the fake Rolex on. And so my investor was thinking, man, I want to be like that, right? So you look the part. Source credibility can be faked. Social consensus. 70% of investors rely on family and friends to make investment decisions. Social consensus is that group pressure. Everyone's doing it. And in some of the cases I've prosecuted, it's the person who prays with them on Sunday morning. They take that time, they infiltrate the group, and they've become part of that connection, and people trust. It builds trust because they're part of that group. Reciprocity is the free lunch seminar, doing something small in return for something big. In the broker's world, it's I'll cut my commission, or I don't have any shares left, but you can have some of mine. And so it's that small favor, and we are trained. You don't show up at dinner without wine. You don't show up you give something when you get something. So when somebody gives you a free lunch seminar, people are more likely to turn over their retirement dollars. And finally, the closer is always scarcity. Scarcity is I've got someone online too, I've only got 1 unit left. Do you want to make this decision for your family, for your future? It's that fast talking, emotional ether. And if we can teach investors to step away from the emotional tactics, those emotional triggers, and think, ask and check, take the time to consider what this decision means for them, that's the classic red flags that investors just miss time and time again.
Fantastic. Doug, if you could weigh in, I know another barrier that you alluded to a little bit earlier is the privacy laws. And recently we've had some guidance come in. So if you want to talk a little bit about what the barriers are and what that guidance is, and then Lourdes can weigh in on that guidance as well.
First, I'd like to comment, after hearing Rebecca do those sales pitches, I'm glad she's with the good people. Because I think her alternative career
Might be
would
more
be-
lucrative, but I wouldn't sleep
and
at
would be
night.
really scary. So, we have the privacy laws. They're great. It's meant to protect all of us from having our secrets go out. Making sure that companies like Wells Fargo honor what you want in terms of where your information goes. That becomes a difficulty, of course, when we need to report it, when we're thinking about a scam, when we want to know, can we talk to someone else? There is recent interagency guidance, which was referenced earlier, that is helpful. It provides that generally disclosure of this non-public information about consumers to state, local agencies for the purpose of reporting suspected financial abuse will be allowed. And then it has specific exceptions where we can make the disclosure to comply with law, may disclose it for a properly authorized civil, criminal, or regulatory investigation or subpoena, to prevent actual or potential fraud or unauthorized transactions, which would allow us to report it to appropriate authorities in order to prevent that fraud. And it allows certain specifically permitted or required disclosures under the law. You may have noticed as I went through here, I emphasized some particular disclaimers like properly authorized, legally required, et cetera. The reason I did that is I think this is a huge and important first step. I don't think it goes near far enough, because how many, I described 4 situations earlier. Incidentally, only 2 of those could we take action. When I described those 4 scenarios earlier, 2 of them we decided we could do nothing. I'm not going to tell you which 2. You can think about that later. The problem is we don't have, it takes a lot of research to decide whether something's properly authorized, to find out whether it is under a law. What we think the next step is like certain state laws that allows you to freeze an account or approach a relative if you have a reasonable belief that something may be occurred. Now, usually the financial industry is up here saying we want black and white rules, tell us which side to step on. Here's one where we think that the time pressure and the goal here is to stop the funds from going out. The only way that that's going to occur, Rebecca can chase it forever and does great work, but the question is, do we have the ability right now to stop the funds from going out and to contact a trusted advisor or relative? That cannot require a lot of legal research. That requires us to be able to act on facts that say a reasonable person would believe something is going on here that ought to be slowed down. And that's where we think the next step, and some states like Washington have taken that step, and we're working on that because the 5 factors Rebecca indicated, if you start pointing out, hey, that was a fake Rolex, and that you can rent a car for like that for $100 a day, and it's funny, Google doesn't say he lives there. Maybe you can slow down that transaction. So great first step, important first step, but there's a lot more work to be done.
Lourdes, do you want to weigh in on the guidance?
I think my job here is to be a little provocative. At least I was told that by a colleague of mine. Doug has made excellent points about the privacy law and the restrictions that imposes. We've spent a lot of time talking to firms about these issues, and I've really come to conclude that we don't have a privacy problem. We have a communication problem. Because by the time a firm finds out or realizes that there's a potential problem, and they realize they don't have the permissions in place from the customer to contact somebody, it's too late. They need to have the conversation before there's a problem. So firms want to be able to contact someone whom they think is a trusted family member, trusted advisor. The problem with that is if you haven't had that conversation with a customer before there's a problem, you don't know if you're contacting the good son or the bad son. So all of a sudden, what became a potential diminished capacity problem has now become an actual elder financial abuse problem. Because all of a sudden, that son realizes that mommy or daddy have $2 million in their account, and they didn't know about that before.
Right.
When FinCEN, the agency responsible for receiving these suspicious activity reports, did an analysis of the elder financial abuse reports that they had seen, this is what they said. The bottom line: SARS generally reported patterns of financial exploitation perpetrated by a relative or caregiver against elderly victims. It's the known trusted advisor who's exploiting the elderly victim. So I think what we really need to concentrate on as an industry and as regulators is how do we help address this problem before it becomes a problem for the individual. And we're not going to get 100% right or be able to help 100% of the people. Maybe we can help, as an initial matter, 80% of the people if we can somehow routinize these conversations before there's a problem.
I totally agree. What we've done as part of our training with FAs is to say, look, if you have this conversation when somebody's 80 and you think there's an issue, what they're going to hear is, you don't think I'm competent. If you have that discussion with somebody that are 50 and say, hey, look, they're probably taking care of a relative or worried about a relative and say, someday I'm going to be there, then you can begin having a conversation. Do you have the POA? What is your plan? What's going to happen to you? You can start out talking about what if you get hit by the bus and you're paralyzed and a vegetable. That's an accident. That's not me getting old. And you can begin that planning process. We have a planning process, great planning process. Our competitors also have great planning process. We call our Envision. It's a talk about not for investment performance. It's talking about where you want to go. Talks about things. Do you have an estate plan? Do you have a POA? Do you have a health care? Well, we don't sell, health care plan, but who's going to take care of you? If you have that conversation every 6 months or a year from a period where, frankly, it's only relevant in an accidental situation, then it's a continuation of a discussion. They're hearing the same discussion that you had for a decade. They're not hearing, oh, you don't think I'm competent to handle. So totally agree. And, oh, by the way, probably over that decade, you'll hear, bad son, good son. The amazing thing that a good FA and a good advisor learns is not what you want, how much you want to earn in the market this year, but what you want to do with your life. They learn what your family problems are. They know who the good family are, the bad family. Hey, I want to take care of both kids. You can have that discussion when it's non-threatening. And that's become an integral part of ours, and I know others' training programs, because when you get to the point where that person's in the office, it's probably a decade late.
Absolutely. And as you can see, our panelists have already, within their comments, started talking about potential solutions, right? But before we transition into that part of the panel, I want to touch on one last barrier, and that's something that you don't talk about a lot, and that's age discrimination. Commissioner Aguilar mentioned in his speech that folks often retire much earlier than they expect, 7 years earlier than they expect, and oftentimes that's involuntary. So Ryan, if you could weigh in a bit about how does age discrimination play out, and how does that exacerbate the vulnerability of seniors?
Well, I think in a couple of different ways. One of those ways is, SMEETA, you mentioned earlier the economic times that we've been in recently, and many older people have experienced layoffs or involuntary unemployment or whatever euphemism we use to describe it. And unfortunately for those people, when it comes time to go back into the labor market, there's a lot of research showing that the longer you're unemployed, the harder it is to get back in. But also, unfortunately, the more you don't look like you're young or something like that, the less likely you're going to get back in. You know, Lourdes mentioned earlier what we use is age discrimination markers. And remember that for employment, age discrimination begins at age 40. And realistically speaking, you know, the older you are, once you start getting a gray hair or 3 or 5 or 10 or start looking a little gray on top, it gets harder and harder to get back into the job market, especially when people think, well, that person's overqualified. We don't want to, that person's not going to be happy in the job. That person's, sometimes it's subtle and sometimes it's not so subtle, and it's really hard for those people to get back into the market. And I want to give a couple of shameless plug to our report from a couple of years ago on protecting older investors, challenge of diminished capacity. We talked about the privacy regs, and one of our recommendations early was on clarifying what the privacy regulations do and what they don't do. So are glad that one of my former colleagues was able to work on that interagency advisory.
And I think that's a great transition. So now we're in the third part of our panel, really talking about, you know, we've laid out the magnitude of the problem of what's confronting older Americans and talking about what barriers are underlying that or really fueling that. And our panelists have started to sprinkle in their remarks possible solutions. And I think you heard from Ryan, one of the solutions is a strong word, one of the steps that AARP had advocated for was the privacy guidance that just came out, that was promulgated interagency-wide, and I'm proud to say that the commission was a part of that. So let's have a broader discussion now about what other steps forward you all see. The one that folks always talk about that we all agree is not enough, but I think is a good starting place, is education. And so I think if I could have you guys weigh in, and Lourdes, maybe you can weigh in from the regulator perspective, Ryan from the senior perspective, and Doug from the industry perspective. When we say education, what is that education, and who should be doing that education?
You want
Either way, Lourdes, why don't you start off?
Well, I come back to my earlier remarks that I think some of the most effective time to have this conversation, and Doug really explained this much more eloquently than I did, is before there's a problem. So the time to educate the investor is before there's a problem, possibly as part of the onboarding process. We have gone and we have spoken to a number of firms over the years, and some of the things that we saw were investors were allowing a trusted family member to receive a duplicate account statement, for example, so that trusted family member could see if there's a problem. FINRA a few years ago put out a template for an account opening agreement that firms could download and then modify for their particular business. One of the questions in the template is, who can we contact in case of an emergency? Maybe that's something that could be modified. So I don't have the exact words, but who can we contact if we have concerns about your account and we can't reach you, or something that is broader that would allow the firm to contact a trusted family member. And also, you know, considering changing, if there are changes to these privacy notices that firms have that they would want to consider, so that they can contact that trusted family member in case there's a problem. But I really believe the education of investors needs to happen before there's a problem. The second place where we've spent a fair amount of time with FINRA is educating the reps. How can a rep identify that there's a problem? And we're not asking them to be medical doctors, just to notice that something is off and escalate that problem. So we've spent a lot of time on that over the last few years.
You know, one of the things that the reason why we did this report in the first place is Lourdes and I have been working on this issue for quite a while. As a matter of fact, I think we go back at least 5 or 6 years on this issue. And I know Doug's been working on it, and Doug's colleagues at Wells and Wachovia have been working on it for a number of years as well. But one of the issues that we started with was, so we get to the point of escalation, then what? And that training that we were talking about and the educating, education goes for everyone. Educating the reps. You know, one of the things we found in our study was very few firms at the time were actually doing education on financial fraud, financial abuse, and diminished capacity, but just about everybody thought that they should be doing it and it should be required. And nobody was opposed to actually being told, you know what, as part of your continuing education, why don't you take something on this? I think, you know, progress, one of those things is I've seen a lot of firms as leaders in the industry have started moving and saying, you know, we foresee a problem. We're already starting to have problems with our clients. That other firms have finally started to get the message, and I think it's rolled around. I think that there are more conversations going on now than there used to be, and I think that there are those conversations are happening across the financial services industries. And I know that Wells is, for instance, I know Wells has a reputation of doing it on the security side, but I also know that they're working on it on the banking side as well. So I think, you know, one of the encouraging things that I found, I was asked to speak at a conference recently, and one of the people said, well, the reason that we wanted to go into financial abuse is because we had somebody speak on diminished capacity last year, and I said, who? And they told me the large financial services firm, and I said, well, that's funny. About a year ago, I had a conversation with that firm, and they were wanting to set up a compliance thing, and they wanted outside counsel, and they wanted to know who. Lo and behold, it is happening. So it takes some time, but it's starting to work.
So let me comment from the industry perspective. We're focused on the clients, our FAs, and our managers. On the clients, the real issue is if I would look at it, you know, there used to be diseases people didn't talk about, right? Until you found out, a sizable percentage of people actually get that, and somebody I know gets it, blah, 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 and then it becomes, so and I didn't coin this, Ron Long, break the silence. Get out there and tell clients, if they could hear 70% of the financial fraud is going to be a family member, you know, the numbers of the things that happened, hear these stories. You know what? A, your guard's up, and B, if something has happened, you just don't go sit in your apartment ashamed or in your house. You seek help. You got to get people, hey, it's not shameful, it happens. This does happen. It's like something unfortunate. Break the silence, seek help. Don't be ashamed. And we've developed a seminar in the box for an FA. It's a CAM seminar. It's not sales pitch. It's purely about this issue. The Wells Fargo Bank side has hands-on banking courses they do in the community. Again, it's education. Our best protection for a client is for it never to happen, not to be trying to recover it. To get that message across, though, we also have to educate our FAs and our management. We started with the management. We have a risk college. Every manager in the brokerage company has to go through a risk college. It's got 100, 200, 300 level courses, and you have to take you have to actually write a master's thesis. One of our courses is on elder financial abuse. One of the most innovative things, well, at least fun, we actually had an improv troupe come in. Sounds silly? Okay. But, we all think we can tell people exactly how things work. Well, imagine this. There are three of you. Now, every 30 seconds, one of you is playing the FA, one's the mother, and one is the daughter or son. Every 30 seconds, you're going to change roles. We give you the role playing. All your cue is financial advisor calls mom in because of noticed withdrawals and is questioning what's going on. It can get very ambiguous very soon. Is that the good son? Is that the bad son? It's switch. What we're trying to get across to our managers, these are very difficult situations. Don't prejudge that this is a black and white world. These are very difficult. And that's just one level. Every FA has to take a course on elder financial abuse. For all of our biggest producers, every one of our seminars last year, year before last, we brought in an outside expert to talk about how do you age? two key takeaways that my wife and I have actually used with our parents. He said, if you get anything out of this, the two most important things is they don't want to lose control, and they're worried about their legacy. How am I going to be perceived? And how does that play into financial abuse? If you don't want to lose control, do you want the kids? Do you want somebody else involved? How am I going to be perceived? Am I going to be remembered, oh yeah, Dad lost all the money in that scam, et cetera? So, I mean, what we're trying to do is spend a lot of resources to tell people we got to be on the front line. We have our own phrases: own it with our FA, observe what's changed, wonder what's happening, negotiate. Hey, can we do this later? You know, slow it down, isolate, get the client alone, get those three representatives from another financial firm out of there and say, what's going on? And then tattle. Take it to your manager or take it to the family member if you have authority. But this is the education. This isn't one and done. This is changing it really is changing the dialogue we need in the United States, where it's not embarrassing to be targeted. It's actually not embarrassing to have a problem, because that's the world we live in, and the only way we're going to get people educated about this is to have that conversation.
And
If I
Rebecca-
may say something.
Oh, yeah, please.
A compliance officer at a major firm told me that the way she trains reps is, she says, if to detect suspicious activity is you're looking at whatever's going on and you say, what's up with that? And if you stop and you say to yourself, what's up with that? You really need to pause and think, is there something going on here?
Great. And Rebecca, if you could weigh in here, what more can we do to empower seniors?
Absolutely. There's a couple different things. One, what I like that we've heard so far is that it's a multifaceted approach. Education is a multifaceted approach. One thing that's worked well in Denver and the Rocky Mountain region is that we're not just educating the investors. We teach them to recognize, refuse, and report the fraud. We work on that. But what we also work on are our fellow regulators in the states, the police departments in the states. We have working groups that meet regularly, and we give them a point of contact. It's me at the SEC. You can call me. So this works. We work with the AARP Foundation, which is our local grassroots educational effort, and they have a hotline, and they get calls regularly. I got a call Friday, this last Friday at 5 o'clock, with a guy who said the FedEx truck just pulled out from this guy's house. He's got a $100,000 check. Is this a fraud? What can I do? And it's the AARP person that has called me to say, this looks suspicious. What can I do? Give me the name. Let me look it up. Is it a registered entity? I can immediately help you figure out who they're dealing with. I can't tell you whether or not it's a fraud, but I can tell you all, yes, this has the hallmarks of a fraud, and you should alert that individual that this has all the hallmarks of fraud, and we can step in faster. So educating in your community, the regulators that work together, that's where another piece of the education component can come in. And then empowering seniors. Studies show that when you deputize someone, if you empower them as opposed to play the victim, you're not smart enough to resolve this. Instead saying, I so understand how hard that must be to have lost that money. That's a difficult situation to be in. But you now are a trained fraud fighter, and you can help others. You can be in the community. You're the one that can make a difference. That helps with reporting, and it inoculates that individual from future fraud when they feel empowered. So if we can together deputize our victims, deputize that senior population, because it's just like a storm. In Denver, when we get a blizzard, you fill up your car, you get an extra gallon of milk, you get prepared. When people are prepared that fraud can happen, they're on the lookout and they're ready when it does come. So if we can empower them through deputizing them to be trained fraud fighters, to go through the curriculum to recognize, refuse, and report fraud, I think that makes the difference from an enforcement perspective.
Great. Well, as you all can tell, we are not lacking for content, so we can continue to go on, but I'd like to use the next few minutes, because I am also cognizant that we stand between you and lunch, so I want to make sure we end on time. But if any of you have any questions, it would be great to incorporate those. So I'd like to turn it over to you, in case you've been thinking as we've all been talking. Yes. And I guess there's one mic over here. You just want to...
My question is really about what kind of tools are available to people when they suspect that there is fraud or abuse going on. And I'd like to give you a little scenario, if I may. Our company provides in-home support services to seniors and others with special needs. About, I'm going to say 3 or 4 years ago, we got a call from a trust officer to contact one of his clients who was coming home from rehab. We made that contact, did an assessment. One of the things that we decided was she needed a stair lift in her home to accommodate her coming home from her rehab, hip replacement or whatever. That was fine. We were unable, though, to really put a companion into the home on any kind of a regular basis because, don't you know, her good neighbor Rose was there to take care of all of those things, and Rose stopped in every day, yada, yada, yada. Now, as it turns out at this point, yes, she does have some dementia, but I think perhaps the more important consideration at the time was isolation. And I, at one point, was very angry at the trust officer for not alerting us to what was going on. We had some suspicions about Rose, but you know, the money was disappearing from her account. Of course, we didn't have access to that knowledge. It turned out that Rose made off with a whole lot of this lady's money. In talking with the trust officer and the client, it came out that he had actually been in contact with her on a number of occasions over the past couple of years, expressing his concerns. Yet she seemed, you know, very strong in her support of her friend Rose. Now, the trust officer, as it turns out, had POA, but as we know, a POA can be given and taken away. The trust officer, at the time he called us, did not want to exercise his POA. He felt as though the woman had sufficient capacity, mental capacity, that she could still make her own decisions. So my question is, what tools are available to intercede when we think something is going on? And as one of you mentioned earlier, Adult Protective Services tends to be focused more on physical than financial abuse.
I'll take that one. First, I think it's great that you have the in-home services. I think that's another line of defense that is something I think we could all explore. That's brilliant. First, from the SEC's perspective, anyone can file what's called a tip complaint referral, and it can be done anonymously, online, immediately. All you need to do is give us the facts, and you don't even have to admit that it's you who's submitted the complaint. Those get reviewed daily, and I can tell you they're reviewed by both enforcement, trading and markets to ensure that there's not a tip here. When it's a tip that is not within our jurisdiction or we can't take action, we do generally try to share those with other agencies. Additionally, a lot of attorney generals throughout the states, for example, in Colorado, it's my hometown, so I can speak to that, they have a hotline. It's a 1-800 hotline, and you can call in and you'll speak to an individual. It's not a reporting line, it's an individual. What I truly like about it, and I know AARP has some similar capacity, they have seniors who will spend the time on the phone. So if it's an isolation issue, that gives that senior who is homebound an outlet to talk to someone who's not going to defraud them. And so there are resources out there where that senior can get direct help. You can direct that senior to help. And if you report, for example, to Elder Watch, the AARP Foundation in Colorado, they will make the outbound call to the senior at home. So it's a more proactive approach. So there's both, you can file the complaint and someone will review it, but you can also take action on a more individualized level within your own community. And I'm happy to give you the numbers afterwards if you'd like them. Yeah.
I just want to add, you know, we've said this thing a couple of times where, you know, the law enforcement and others won't take the call if somebody's not being physically abused, but frequently, financial abuse is only the first step to physical abuse. When a family member or other person who's trusted starts to abuse somebody, it may start off as only financial abuse, but it does frequently escalate to physical abuse. So, you know, if we catch those things early, we can avoid a couple of problems.
Great. Thank you. All right, these will be our last two questions.
Thank you. In full disclosure, I am the Securities Administrator for the City of Washington, so I've been looking at this and concerned about it for some time. And I'd like to sort of, one thing, I think this is a great panel, and a lot of what you've said is well said. I'm concerned about writing off the APS people because they are the authority that the mandate applies to. So don't write them off, make them better. The whole point of physical versus financial abuse, train them. They're not investigators, they're not enforcement, they're social workers. Train them, encourage them to get more power. Some of the financial institutions take what I call a Geneva Convention approach. They will provide the APS with the minimum that'll enable them to say, yeah, we reported it, but if there are follow-up questions, they freeze. So it's not just that APS is incompetent, they don't get the cooperation that they need from some of the financial institutions, not Wells Fargo. But Wells Fargo has been phenomenal. I just also want to say, in connection with state activity, Don Blandon is sitting at the back of the room, the head of IPT, and they have done a fabulous job of trying to get the word out to the medical community, which is another part of this whole network. It's a big picture. The legal community, the estate lawyers, there are lots of people that have skin in the game. Let's find ways to make them all be useful.
I couldn't agree more. I mean, we don't write them off. Actually, when I think about my budget and what I have to handle, and then I look at what some of our comrades, in states have to deal with. Missouri, at a conference, said they had over 6,000 complaints about elder fraud abuse, and the ability and very limited resources. Our experience is that the people in these positions are dedicated, they're hardworking, but they're tremendously under resourced, and it goes back to that issue of who can you help and how can we get more resources out there, because this is just going to continue to grow.
And I think the goal of every member of this panel is to utilize every single potential resource that could be out there. So I think you heard a lot about partnerships, private, public, utilizing local, state, and federal resources. And the goal really of talking about the challenges is to figure out how to address them and move forward. So I think point well taken, but I think up here everyone is solidly looking for ways to build broader and broader partnerships, because let's face it, at every level, we're in a world of under-resources, and we don't expect that to change anytime soon. So our last and final question, no pressure.
Thank you. Thank you. I just want to kind of distinguish a little bit the hard comments about the bad son versus the good son, and probably also the issue about dementia as the cause or in any kind. What I have seen, at least in some of the Hispanic communities, is first, sometimes the bad son doesn't realize he's the bad son. It's just that father has this amount of money, and it's a great time to entrepreneur. And they would ask for the money, they would put some restaurant or some, I mean, there's not malice, there's not a bad intention. The results are actually quite the same. The money is gone, and so the first question would be, how do you consider, how do you protect somebody intentionally, with good intentions, doing a terrible thing? And then the second point is sometimes it's not an issue of the person not having a reduced capability mentally, but some people just see their balances and say, hey, this is not going to last. And therefore, they are, I would say, more inclined to listen to somebody that presents a 20% or 30% per year return, because that's going to be my save plan. So sometimes it's not that the schemers, I mean, they are the ones that are targeting, but sometimes it's the person that it's putting themselves in this position, and what can you do or what can we do in terms of protecting these people that are approached by these grandiose investment ideas? At the end of the day, the result is exactly the same. People lose their pension assets and they are in not better shape. Thank you.
Ryan in the back.
Yeah, your first question, I think, is a good one, because there are people who want to do right, but, you know, they think, and I think Doug alluded to this earlier too, they think, well, mom's going to give me the money anyway. You know, what's the matter if I take some of it a little bit early? Or they might be a caretaker for mom and, you know, say, you know, mom wouldn't mind if I took $20 out of her account this week so that I can go to Starbucks, because I'm taking her to the doctor anyway, and you know, I need that caffeine boost to be able to get mom, and she would want me to have gasoline money too. Oh, and after, you know, mom would want me to have new tires on my car, and then mom wants me to have a new car so that I can take mom to the doctor because I'm doing that anyway. Well, that is one of those issues of escalation, and recently, the American Bar Association just put out a series of books on advising those who are non-professional fiduciaries in how to do their duty. So that's one reference and place to go to learn how to manage other people's money, because it's hard enough to manage your own money. Starting to figure out where the lines are in managing somebody else's is pretty darn hard. So.
Great, Doug.
I think both those were excellent real-world examples. On the first one, what we're trying to get our clients and our FAs to do is have a discussion about goals, not financial goals, life goals. Do I have enough to retire? Do I have enough for retirement? Don't worry about what the market did yesterday. Think about what you need to do to live out your life. And if you're, you know, projected 85, 90, and you give that money up, you're not giving up $30,000. You're giving up an income stream over the next X years. So if you can show them, hey, here's how close you are to your goal, but here's where you are, because that starts out real small. You're not talking about performance, you're talking about life goals. So you have to put it in a different context as to what that really means. And on your second issue, this is a bigger issue than scams. This issue of, hey, I don't have enough to live. All right, am I going to put it in a bond and get basis points yield? Do I put it in the market? Look what happened this past week. Well, you know, everybody instantly forgets what happened the last year. Do I take the money and spend it now rather than invest it? And from our perspective, you know, there isn't a good answer to that, particularly since the heirs, when mom or dad dies, are going to come in and say, why'd you put mom was 80 years old, why'd you put her in a 30-year bond? She wasn't going to live 30 years. You know, you got a perfectly rational response, which is, well, I could have just had her spend the money to buy food. I could have put her in a 2-year bond, but she would have had to also be amortizing principal. Or I could have put her in the stock market and principal is at risk, or I could buy one of those complex products which she didn't understand. I mean, you know, it's a very difficult discussion to have. And when people are desperate, they're going to reach for yield. And it's not just the scamsters. It's, you know, frankly, legitimate firms are having this discussion with millions of clients every day to try and say, does this work? Am I reaching? Can I maintain my present lifestyle? And you're having it with clients that you have to make sure that understand it. So it's a very difficult and very real world question.
Great. Well, thank you. And if I could get a round of applause for my panel.